This paper started really at the Macro 3 conference in 2015, when Augustin Carstens was talking about how emerging markets might defend themselves against volatile capital flows. And what Carstens says is when there are big inflows coming in, the first buffer is a flexible exchange rate, which makes sense. And then he says, but sometimes the exchange rate is moving so much you have to do FX intervention. But that's not always effective, and anyway, there may be excessive credit growth coming from these capital inflows, so you want to do macroprudential. And then he says, but sometimes the money bypasses your domestic banking system, it's coming directly from abroad or foreign banks. And so, everyone's thinking, okay, next he's going to say you impose capital controls, right? And then he looks at at the clock and he says, oh, I only have 8 seconds left to talk about capital controls, but that's okay. I don't need any more time than that to tell you they don't work, I wouldn't use them, I wouldn't recommend them. This was kind of interesting. His own logic had taken him right up to using capital controls, and just at that moment, he pulls back, almost as though he himself is surprised at what he's about to say. Oh, by the way, what he says is, if you impose capital controls and investors can't take their money home, then you'll get a very bad reputation in your country. So he's already switched from inflow measures to outflow measures. Okay. And it got us thinking, why is it that inflow capital controls have such a bad name? And it's kind of interesting that even countries that do use them or think about using them will always try to use some kind of euphemism. So they'll start talking about prudential measures rather than capital controls, even though what they might be doing are essentially capital controls. Or people say, well, they're not going to be effective, and so you shouldn't use them, but, because there can be evasion and circumvention. But nobody says, well, we should abolish taxes because God knows people try to evade taxes, right? So there's somehow this perception that they are bad. What I'm going to try and argue is that we need to go back into the history of capital controls to understand why we have the perceptions we do. And I'm going to suggest there are really 3 or 4 reasons why inflow controls, and I'm going to be talking about inflow controls, have a bad name. And the first is that capital controls and current account restrictions are often kind of mixed up in people's minds. And there's good historical reasons for that, essentially because these were often exchange restrictions. There's a sort of sense that, well, you've got to get rid of these exchange restrictions, of course, to have free trade, and capital controls are part of restricting trade, and therefore they're bad. That's actually quite different from the perception, which I'll come to in Keynes and White's time, which was that if you had free capital mobility, you would not be able to have free trade. Okay. Why? Because capital movements are going to lead to big exchange rate misalignments, and then there'll be huge protectionism pressures in the country. So Keynes and White thought that capital controls are a pro-free trade measure, whereas I think many of us, or more recent thinking is, capital controls are anti-free trade. The second reason is that inflow controls and outflow controls get inextricably linked in people's minds. And so whenever you talk about capital controls, even if it's in the context of restricting inflows or putting some kind of tax on inflows, kind of at the back of people's minds is, oh, capital controls are bad because they're outflow controls. The third reason was a kind of a rise of a free market ideology, and sort of post-1970s, this idea of Keynesianism and demand management kind of got a bad name. And since one of the purposes of capital controls is to break the trilemma and give you an independent monetary policy and give you some fiscal space, along with this sort of free market ideology and discredited Keynesianism, that was another reason why capital controls got a bad name. The last one is a bit more specific. It's sort of concerns about some large exporters, originally Germany, Japan, more recently China, use capital controls to keep an undervalued currency and sort of manipulate the exchange rate. I'm going to go back in history and sort of trace how controls have been viewed. So I'm not a historian. I have a very simple linear conception of history. There it is, a straight line. And so let me speed up a bit on just going through this. Okay. So, of course, we go back to the late 19th century, the kind of golden era of financial globalization. Countries like UK, France, and Germany are the major capital exporters. Britain is exporting as much as 10% of GDP. Where is this capital going to? It's going to the US, it's going to the New World, it's coming to India. So the developing and emerging markets of the day were the major recipients. This was mostly long-term capital, quite volatile in some sense. There were various panics and so forth, but it was financing a lot of development. So a very liberal international order. Large capital flows are supported by the gold standard, which essentially eliminates exchange rate uncertainty. Central banks are focused on external stability, and so monetary policy is geared towards safeguarding the gold standard. Britain is generally speaking quite happy to allow this capital to leave the country because they're financing things like railways, and there's demand for British exports of rolling stock, etc. France and Germany are slightly different, but are fairly liberal on capital outflows, and very few restrictions on capital inflows, mainly countries worrying about political control that's coming with foreign investment. Of course, we have World War I, where capital flows, particularly between the old world and the new world, come to a halt. And then in 1919, after World War I, there's sort of this effort to reestablish this liberal international order. There was something called the Genoa Conference, and has this wonderful phrase: all artificial of controls of operation and exchange, and they're talking both about current and capital transactions, is futile and mischievous. That's a wonderful word. The world has kind of divided up now. Austria and Soviet Union have outflow controls, and the US, which is now the most important economic power and the major creditor, and the UK are pushing to reestablish the liberal international order. The gold standard, it's reestablished in the mid-1920s. Germany goes back to the gold. Britain goes back at its pre-war parity, so huge deflation. France, rather cleverly, goes back at a much depreciated exchange rate. And so by 1928, most countries are back on the gold standard. But that new restored liberal international order doesn't last very long. There's this famous sudden stop to Europe. The gold standard collapses. Britain is forced off gold, and so countries start imposing all sorts of exchange restrictions, actually all on capital outflows. Okay? And so there you have the number of countries imposing exchange restrictions and or abandoning the gold standard. There's a chaotic period of exchange and trade restrictions and capital controls. What's interesting is the US, so by now we're in the late 30s or the second half of the 1930s, the US starts experiencing large capital inflows. Okay? And they start getting concerned about this inflow surge as, so here you can see, so this is the current account, and then these bars are the various components of the capital account, essentially as evading the death penalty, the Jews managed to get some of their money out. And anyway, there's all sorts of worries in Europe, and that money is flooding into the US. And the chairman of the Fed, Mariner Eccles, starts saying, well, these inflows, they complicate basically our macroeconomic management, and there's a clear case for adopting measures designed to deter the growth of foreign capital. So he's proposing inflow controls. In the end, the US does not impose inflow controls. Henry Morgenthau, who was then the Secretary of the Treasury, is opposed. He says, I'm opposed to exchange control except as a last resort. Frankly, I disapprove of it. Okay? There were first very few precedents on inflow controls. Okay? Switzerland had used it once. That was it. There were some practical difficulties about collecting taxes from foreign investors. The US wanted to maintain its position as an international financial center, and so that's another reason why they don't want to impose inflow controls. And I think more importantly, this quote from Arthur Bloomfield, exchange control was regarded as inherently objectionable and a perversion of the pattern of international payments, worthy only of totalitarian countries or justifiable under extreme necessity. But bear in mind that these totalitarian countries are preventing capital outflows, not inflows. All right? But nevertheless, already in everyone's minds, the very term is kind of mixed up with the Nazis and the Soviet Union and so on. Keynes and White actually have a very different perception of capital controls. So they disagreed on, obviously, many things. The one thing they did agree on was the need for capital controls. And their vision was there would be structural capital controls. Why? First, because the interwar period had been so chaotic and so destabilizing and had led to so much trade protectionism. They thought that the only way to safeguard free trade was by having capital controls. Also, Keynes, obviously was a Keynesian and wanted to be able to use macro policy, and so if you had free capital mobility, you wouldn't be able to have expansionary policies without the money leaving your country. So their original proposal was for have a structural capital controls kind of permanently in place, and as I said, given the choice between free trade and free capital flows, they preferred free trade, particularly against hot money flows. Their vision also actually involved both recipient and source countries enforcing these capital controls, so countries cooperating in that. The New York bankers who had made a lot of money on capital flows kind of intervened at the last moment and forced White to dilute the proposals. So actually the IMF can only request countries to impose controls on capital outflows when they're using fund money, when they're getting a fund loan. But nevertheless, and the idea of cooperation is much diluted in the Articles of Agreement on imposing capital controls. Nevertheless, the emphasis in the Articles of Agreement is very much on current account convertibility rather than capital account convertibility. And under the Articles, countries cannot be prevented from imposing controls either on inflows or on outflows. So the early Bretton Woods period, capital controls quite prevalent, again, nearly always on capital outflows. The UK imposed widespread capital controls after 1947. Even the US in the 1960s. Even the US in the 1960s imposed capital outflow controls in the form of the IET. The main exceptions were Germany and Switzerland that started imposing inflow controls in the late 60s as Bretton Woods was collapsing and you're getting large outflows from the US into Europe. So this just compares the advanced economies with the emerging markets, inflows in controls and outflow controls. Just 2 points to observe. First, in the early period after the war, advanced economies actually were more restrictive than emerging markets. That then switches in the 1960s. And second, nearly always you see more outflow controls than inflow controls throughout time and across countries. The advanced economies did start imposing inflow measures which sound very much like the kind of prudential capital controls or macroprudential policies that we talk about today. So this is the 1970s, embargo on short-term borrowing, marginal reserve requirement on non-resident deposits, reserve requirements on bank inflows, et cetera, a URR on financial credits taken up abroad. So these are the sorts of measures that we're talking about today. They were used very much in the early 1970s by advanced economies. As Bretton Woods breaks down, the US goes back to promoting a more liberal international monetary order. Interestingly, as Bretton Woods was breaking down, and now these were large outflows from the US not only relaxes the interest equalization tax, it declines to cooperate with Germany and Japan to prevent outflows from the US. Okay, so there's been a kind of 180-degree turn in the US attitude. And one of the explanations is that the US realized that through capital flows, they would achieve what they had not been able to achieve through years of diplomacy, which is to force Germany and Japan to appreciate their currencies. Okay? So now they don't care about the capital outflows. They're going to achieve the revaluation of the mark and the yen through capital flows, which they hadn't been able to do under Bretton Woods because there was no mechanism to force surplus countries to appreciate. Let me just take 1 minute to talk about the French connection, which I find just amazing. So France was, of course, a country that kind of liked capital controls. That's their sort of mentality. And among the Europeans, they were, particularly vis-a-vis the US and the UK, the French were generally in favor of controlling capital flows. In the 1960s, they do some liberalization so that the franc could become more of a global currency. But then after the 68 riots, they have to impose capital controls again. Then in 1983, France has a BOP crisis. They impose capital outflow restrictions. But then Mitterrand, which is a socialist government, comes to the conclusion outflow controls hurt the middle class, who are their main political supporters. And his logic is that the poor don't have any capital, so it doesn't really matter to them whether there are outflow restrictions. And the rich all know how to get around the restrictions, so the only people who are hurt are the middle class. And then, so he eventually gets rid of these outflow controls. And there are three officials in his administration. Well, there are many, but there are three that are important. Jacques Delors goes on to become the president of the European Commission, and there he pushes for removing all capital account restrictions within the EU. Okay? And so the EU directive, it doesn't allow any capital restrictions within the EU. There's another man called Henri Chavonsky who goes to the OECD, and he expands the OECD Code of Liberalization. And the third is Michel Camdessous, who goes to the IMF and tries to amend the IMF's Article of Agreement to include capital account liberalization. So three officials from a French socialist government go on to three very important jobs in which they all push full liberalization. So there's still a lot of suspicion about the use of capital controls. Why? I would say these three reasons again. One, association with outflow controls, which in turn are associated with repressive regimes or failed macro policies in the 1970s. The association between capital account and current account restrictions. And finally, the concern that in some major surplus countries, they use capital inflow controls to prevent appreciation and maintain the surplus.
Thank you for allowing me to comment on this paper. It's a really great exploration of the history of how and why capital controls have been thought of and imposed. So I'm trying to come at it from a slightly different perspective of state capacity in trying to think about what are the difficulties in actually implementing capital controls. Control is actually about two parts. It's about declaring that there is a control and actually enforcing the control. And there are many ways you can actually impose or think about capital controls. And one key intuition I would like to contend is separate from other parts of thinking about macroeconomic stability or monetary policy, capital controls are not a set of finite legal instruments. People do them in a varying set of measures and instruments. And therefore, how you think about imposing capital controls is as important as actually imposing the control itself. So for example, there are price-based controls, quantity-based controls, administrative controls. The range of freedom ranges from a complete prohibition to complete liberalization. And just within India, we have all of the above. So the effectiveness of the controls actually depends on what legal tools we are using to impose the controls, how complex these mechanisms are. So you could have a simple prohibition or a simple control, or you could have a fairly detailed restriction, which actually increases scope for arbitrage. The third part is, do people actually understand what is being controlled? And fourth is about state capacity, its ability to monitor what is being controlled and whether people are actually complying with the law or not. In the case of India, we have remnants of a permanent administrative framework carrying on from the past 20, 30 years. So we've diluted a lot of the legal prohibitions on capital inflows and outflows, but the administrative machinery for actually enforcing those controls still exists. So as and when the controls are sought to be imposed, that administrative machinery kicks in. And a variety of literature has actually found that in the last 10 to 15 years, this machinery has had a fairly limited amount of success, and it's had at best temporary success. Three probable reasons I would like to put on the table is, one, we have a fairly complicated architecture in the field of capital controls. Two, we have complicated mechanisms. We don't have fairly simple laws and mechanisms for actually implementing them. And then we don't have the follow-up capacity to monitor whether those controls are being implemented properly or not. So you can see, in contrast to a number of other countries, the number of agencies who can impose capital controls in India is just enormous. It's from the Ministry of Finance, the central bank, the securities regulator, the Department of Industrial Policy, the Central Board of Taxes, the Foreign Investment Promotion Board, the pension regulator, the insurance regulator, right? And I'm sure I've missed out on a few. Contrast this with the others, and there's been some consolidation of how capital control, of who actually imposes capital controls. Then we have multiple laws and instruments. There is the Foreign Exchange Management Act. The government issues notifications when it actually wants to impose temporary restrictions. There is a government-issued foreign direct investment policy, which is also reflected in the FEMA, the Foreign Exchange Management Act regulations, and sometimes they contradict. There are restrictions in other laws which prevent or restrict foreign ownership or foreign inflows. Then the Foreign Investment Promotion Board, which actually seeks departmental comments, but it's not clear on what basis those comments are sought or what those departments are actually supposed to comment on. When we think about due process, there is no explicit objective statement as part of our overall capital controls framework. So usually it's for macroeconomic stability and national security, which is broadly consistent with how other countries think about it, but we don't have an explicit objective for capital controls. Sometimes it's used for fairly explicit or implicit protectionist devices. So our restrictions in multi-brand retail FDI. In other cases, there can also be indirect control restrictions. For example, while we liberalized foreign direct investment in insurance, one key restriction was that foreign investment does not grant you foreign control over the investment itself. There's a similar restriction in the civil aviation regulations as well. There's also a problem of bad drafting in some cases, which is the ECB regulations in India have categories for end-use restrictions. Certain end uses are permitted, certain are not permitted. Both actually are defined, and sometimes applications just fall through the cracks. You don't know whether you are permitted or not permitted. There are similar problems with the FDI policies as well. The last part of this is there is a lack of appellate mechanisms, and that creates indiscipline in how you actually impose capital controls. There is a lack of precedent, there is a lack of pressure to bring about clarity and transparency in the approvals or the rejections that are being granted out. So to conclude, the instruments of imposing controls are actually fairly inseparable from how you think about the controls themselves. Sometimes they are used as tools of protectionism, and this flows from a lack of having explicit objectives in thinking about capital controls. And I would argue that in a low capacity state, which many emerging economies are, complicated regulatory architectures and complicated laws actually create incentives for arbitrage, and they actually do not create effective ways of implementing capital controls. And while there's a fairly complex history of how capital controls have been thought of in different countries, we need to study these instruments or the mechanisms of enforcing capital controls in more detail.